All right, guys, welcome to the investment committee from Greenridge Wealth Planning. I got Sean here, Brando, JK, and Stuart Brown. We've got a couple things on the agenda today. We're gonna, as usual, make it kind of brief and to the point. The whole idea is not to keep you here for any much longer than about an hour. So we'll get through some market commentary real quick, and then we're gonna cut over and talk more about selling a business. And when you're selling a business, what are some of the things that you need to think about? What's the process look like? And Stu's going to help to fill in and give us some color on the current state of the market, as well as some of the things you can do to gear up if you're contemplating selling at any point, whether now or in the future. So, Sean, can you pull up the slideshow for us?
Yeah, can do.
All right, there we go. GRWP, the investment committee, Thursday, April 11th.
So just having a bit of an agenda here. We want to give you the market update and then going to discuss M&A with Stuart as Bobby mentioned, and then just a Q&A at the end if anyone has questions.
If anyone has questions during, please just put it in the chat room and we'll try to address them real time and live.
Oh, yeah. So first thing we want to cover is just a review of the market vitals so far in 2024. The S&P 500 is up 8.5%. So as of our last webinar in March, it was up about 7.6. So we're continuing to see strength in the markets, up another 0.9% since that last webinar. And one interesting thing that I want to point out is the NASDAQ is finally lagging a little bit behind the S&P 500. Through the first 3 months, we were really seeing that technology really lead the market and pull the market up. And now we're seeing some other sectors of the market start to rebound a little bit as well. Gold in the last month is up 8.85%. Energy is up a little over 9%. We're seeing industrials up 2, communications up 3. So we're starting to see a little bit more breadth in the market where other sectors outside of technology are starting to do a bit better, which has been interesting. And another thing I wanted to highlight is just this strength of the US dollar. This has been a consistent thing in the market for the last 15 years. Part of the reason why international indexes have really lagged behind the domestic indexes like the S&P 500. About 3% of domestic U.S. returns in the market over the last 15 years can be attributed to just strength of the U.S. dollar. So that's been a big consistent in the market, and it's helped the U.S. really outperform those international indices.
That's an awesome statistic, Sean. Let's unpack that a little bit. I think just kind of highlight that's a concern I feel like people have as we look at global politics. We look at the world just kind of seeming a little on fire, or at least certain parts of the world being on fire. And people, when they think about currencies, which are generally a complicated topic to start with, you say, oh, the US dollar's done well. And probably there's a group of people that would say, yeah, right, not for long. What are some of the components that have led to that strength of the US dollar? How does that kind of translate through in your head?
I think a lot of the strength of the US dollar just comes to the strength of the companies that we have domestically. I think the companies that are really leading the innovation and technology game, like Apple, like Meta, like Amazon, like Google, are really blowing up worldwide. And that's led to the US dollar being just stronger because those companies are really driving the growth globally, really, for those sectors of technology and innovation that have really grown over the last 2 decades. So I think that's definitely a big factor. And people always kind of look to international as a value play. It's very cheap compared to the US. But I think until we start to see that dollar start to diminish a little bit and start to see other currencies pick up, it's hard to make that call for the changing of the guard where the international is going to start outperforming, just due to how strong the US dollar has been and the trend that we've seen there. 3% annually of US returns being attributed to the dollar is a strong force to have behind that market push.
Yeah, I think that point that you made about the strength of US companies and how they've had such an impact on the US economy is something that really doesn't get enough talk, especially as we get into an election year. people tend to start to think about government and what the government does and how governments work. And when we think about currencies, we think about governments and the currencies of the government. But really, this is a stock story. This is a company story. And just a fun little fact, Apple, which is down 10% year to date, as you can see in the bottom chart, still has a market cap greater than the entire German stock market. And that's one of the growth economic engines of Europe. And one of our companies in America is bigger than the entire market that they have there. Let's talk a little bit about that bottom box, by the way. Sean, what are we trying to show with that box? What is that box telling us?
I think this just shows the variation of some of these US companies. You're seeing even the giants like Apple have times where they're going through volatility. Meta up 50%, just the kind of the dichotomy of some of these companies that are really outperforming versus the general market. And some of the companies that maybe aren't outperforming as much that maybe you would expect to, like an Apple, that's been such a dominant force in the market over the last 2 decades. As we kind of touched on this in the last webinar, but there's been a lot of news recently surrounding Apple with lawsuits and electronic vehicles and a number of things. Boeing is another name that we've seen in the news.
Bowen's really blowing the doors off the short trade, huh, Sean? Bump.
The great one, Bob. Yeah, they're blowing the doors off, down 33%. But honestly, we think aerospace and defense is a good sector to be invested in right now, given how much space exploration has kind of taken the forefront and just with all the geopolitical conflict. So we think Boeing is part of a group that is going to succeed in the long term, but obviously Boeing specifically has had a lot of issues in the last 6 to 12 months with the lawsuits and all that. And another one that we wanted to highlight that we've been big believers in is Disney. Disney was trading towards its COVID lows last year, and we saw a lot of value there, and that's ended up playing out well, up about 30% so far in 2024. So these are just some interesting names that we've seen in the market that we wanted to highlight in the bottom right. And like I said, it just shows the dichotomy of some of those real outperformers versus some of those companies that have just underperformed the general indices.
Yeah, that mantra that people had of, oh, the Mag 7, only these stocks driving 2023 returns. And you had said something before about breadth. And so the more stocks that are going up, if there's 500 stocks in the S&P, if all 500 are going up, that's considered good. If all 500 are going down, that's considered bad. And the more stocks moving in that direction is indicative of, that's where the trend is going to go. And as we look at breadth, we not only think about the number of stocks, but also the rate of change and in what direction. So 7 stocks were highlighted as last year. It was really more than 7, but those were the stocks really pulling the whole market up. And then if those started to go the other way and all the stocks start coming down, we would say, the breadth is going in the wrong direction. Right now, we see it very much going in the right direction. We see more and more stocks participating and leading and having an average return closer to that S&P return, which is very, very positive from a trend following standpoint. So I think, what this really says is it's not dependent on just a few companies. There's disparity between returns across household names. We're seeing some good stuff. We're seeing some good leadership in some areas. And it's not just industry based. It's kind of broadening. It's very company specific. As you mentioned.
But I think what you're saying is diversification might be lazy asset management.
Well, I think the awesome thing about this, if you look at all these companies, even though they're all big name companies, they've all got very, very specific stories that go behind them. And none of them have been no-brainer wins for some period of time. They've all had their fits and bouts. Meta up 50% year to date, almost great. A couple of years ago when they changed the name to Meta, this stock cratered like crazy. Maybe it was one of the biggest public announcement disasters of all time for a company. Boeing, I watched a 6-minute special on them. It was gut-wrenchingly bad, but it's one of how many airplane makers in the world. You got Boeing, you got Airbus, and a small group of other ones. So, it's something, as Sean said, we'll probably see the rise of Boeing again at some point, and so don't count it out.
Yep. Well, yeah, just want to get into some recent news stories. Everyone might be kind of tired of hearing about inflation and interest rates, but that continues to be kind of the hot topic that's talked about. Just as of yesterday, March CPI came out showing inflation at 3.5%. So in February, it was 3.2. Expectations for March were 3.4. So it came in a little bit hotter than expected. And that just shows that inflation's been really stubborn. And that expectation that interest rates might get cut up to 6 times in 2024, that has definitely dwindled down from that initial estimation. Went from 6 to 3. Now, a lot of experts are guessing between 0 and 2 based on this new March CPI report. So it's just been interesting kind of tracking how this inflation and interest rate story has unfolded.
Well, in fairness, the stubbornness has really only been at this lower level. It's really jumped a lot. And we've really seen a downward trend over the past 12, 18 months that has been significant and impactful. But this area that we're in right now is stubborn because we still have a lot of movement in the economy. We still have a strong economy. So
yeah, that's a great point. I mean, June 2022 is up at 9.1. So we've definitely seen a dramatic decrease down to this 3-ish% level. But with interest rates still at 5%, it's obviously very beneficial for investors that are investing in some of these things like money market funds. Being able to earn 5% in a very liquid, safe instrument like a money market fund is definitely a benefit. Same thing with newly issued bonds that are paying around that level. But as a borrower, it can hurt you when you're getting mortgages or other loans. So those are also remaining elevated as interest rates stay higher for longer.
yeah, I mean, we just even had a conversation with a client who's in a 7-1 arm that started in 2021. Come 2028, now we don't know where interest rates are going to be, but when that thing turns variable, like rates are starting to come to term now that were once a low rate and for a fixed short period of time. That's if the rates do not react in a downward fashion, they're going to see a jump in their payments. And that's when things become a little bit rocky, especially when we talk about the real estate market.
I'd just like to add to that, because we're about to talk about the IPO market after this, and then we're going to have Stuart talk a lot about mergers and acquisitions, how that environment is, and a lot of those things are financed through interest rate loans or some kind of debt. And so as interest rates go up, as that cost of financing goes up, that normally gops up the market, slows it down. Interest rates lower, people usually like to transact more. But what is also interesting is when we wrote in our article back in 2022, we talked about the market. It wasn't just how much things have gone up, but it was about the rate of change. And so interest rates were going up 75 basis points per meeting for a period of time, which was a massive amount of change. And you start to look in directions. Businesses don't know how to function. They don't know where their financing rates are going to be. If you're trying to find a house and you miss this round, and next thing you know, your interest rates are going to be 2% higher. It was causing a lot of stress, a lot of angst. Commercial real estate was supposed to fall off a cliff. There was a lot of stories going around because of that rate of change of interest. As interest rates hang out here longer and longer, companies get used to it. People start to get used to it. They say, okay, this is just what it is, new normal, move on. And as long as people are able to find the refinancing and we don't have massive bankruptcies, the market will just get used to it and digest it. And that seems to be happening as we look at housing prices nowadays. It's not like, oh my God, mortgage rates keep going up. It's now just there's no supply. And we're not talking about the financing aspect. We're talking about other elements. And that seems to be happening as interest rates stay up here, even as Bobby said about inflation, it's down to 3.5. Well, it's stubborn, but it's kind of from a lower rate. We just get used to the numbers. We start to anchor to the numbers after we see them month over month over month. So don't be shocked if we have this conversation in 6 months and inflation is still hanging around 3.5 and interest rates are still at 5. If the economy starts to pick up some steam because we get really used to digesting this stuff, just don't be shocked by that. It's not that it's going to happen, but it could. Anyway,
well, to your point, I mean, something that Warren Buffett had said, right, when he buys companies at fair value. And fair value is dependent on what what your anticipation is of the asset and what the current environment is, and what you expect the environment to look like. So to your point, knowing what the environment is and knowing now that we have quote unquote, a new norm, you could start to make those assessments and you can start making better educated decisions on where you're going to start to deploy money. And if you have to take those loans and the rates are higher than they were, before the interest rates started rising, you kind of, what the playing field looks like now. It's not one of those unknowns. It's now something that you can put some energy and effort toward.
Yeah, it's the normal word that you used is what it's all about. When we were talking to that one client and it was, oh, they have a rate at 2%. And you said, as if we didn't even have to think about it. You're never gonna see that again. Well, if you said that 2 years ago, everyone would be like, what do you mean we're never gonna see that again? Interest rates are gonna come back down. So the environment's changed. All right, let's talk about.
Yeah, IPO market so far is ramping up in 2024. That's something companies don't like to IPO in tumultuous, volatile markets. So we really saw a lower amount of them through 2022, even 2023, but we're starting to see those new IPOs come back due to these healthier markets. So I think that's just good evidence that the market's in a better spot than it was 2 years ago. Some recent IPOs, we've seen Reddit, which is a social media company, Viking Cruise Lines, and Astera Labs, which is kind of a hybrid software and hardware artificial intelligence company. So we're seeing a wide range of different companies IPO in this market, and definitely some interesting names. And one other thing to mention is DJT has definitely grabbed some attention over the last month or two after merging with DWAC, Digital World Acquisition Corp. So that wasn't really an IPO, but it kind of acted like one because DJT kind of became the ticker of that company and garnered a lot of attention. And it's been very volatile so far. It's something we would recommend just not investing with your politics and kind of keeping them separate. But we'd love to hear what you guys think about the whole DJT situation.
I just think that it all comes down to the SPAC market. And I mean, Stuart, you could probably teach a class on the SPAC market. But
I don't know if I'd say volatile as much as I'd just say declining.
Yeah.
It's definitely something that has grabbed a lot of media attention. And in some ways, I wouldn't be shocked if politics have all the oxygen in the room when we were getting prepared and thinking about what happened this month. And we're going through news stories and we're thinking back to the big headlines. It really just looks like a political smorgasbord all over the place. And so Sean said this before, and we'll just repeat it again because it's so important, especially in an election year, especially when you're probably fighting with your aunts, uncles, or nephews or nieces, or, even interior family members about all kinds of political issues. Do leave the political issues for those back and forth conversations. It really doesn't make a lot of sense to put them in your portfolio. We have just seen time and again that, it's better to follow the numbers and not all the craziness of the political atmosphere. So kind of a user warning, do not operate under the influence of political commentary.
Yep.
Very good.
All right, so this is another thing we wanted to highlight. This is something that Bobby actually featured on one of his recent diversification is lazy asset management videos on Instagram. Thought it was a really good chart. Typically, when you see these kind of heat maps, they do it year by year. So you'll see how do these asset classes perform in 2023, 2022, 2021, and it'll be a little bit more of a myriad of colors all over the place. We
It's like
thought
a
it was
mosaic tile craziness.
Yeah, it's interesting when you look at it in more cumulative periods, like we have here, you can see 10-year, 5-year, 3-year, 1 year, you start to see patterns kind of shake out. So you can see as we're looking at this chart over the last 10 years, 5 years, the same names of asset classes kind of show up towards the top and towards the bottom. And this really just goes to that idea of diversification just for the sake of diversifying can be like lazy asset management. So putting a lot of these things that are towards the bottom as larger portions of the portfolio just to diversify ends up kind of just hurting you in the long run when these certain asset classes like US growth, even just the S&P 500 in general, have really outperformed a lot of those asset classes. So utilizing heavier percentages of those asset classes as they're trending up, and as that continues, even as you look year to date, last 3 months, last 6 months, they continue to just be at the top. So I think kind of overweighting some of those and maybe foregoing or lessening the amount that you have in some of these other asset classes like bonds, like emerging markets, can be really beneficial as an investor.
Well, this also supports your comment on the US dollar and the strength of versus international companies.
Yeah.
Yeah, I think that's something we've kind of talked about before in our like investment meetings and things like that. Is really like, waiting to observe some changes and then being able to make adjustments and being a little more flexible, as opposed to just, doing something for the sake of it. As as you kind of observe, changes in the market or in the environment, that's when you can, kind of be a little more flexible and deploy.
Yeah, I think that's a good point. For example, year to date, if we saw emerging markets towards the top of this chart, that might be something that we would look to pivot into, because it's starting to gain that momentum, starting to show a trend. We have nothing against emerging markets, but just looking at some of the data and some of the trends, it makes more sense to be a little heavier towards stuff like US growth, the S&P, more of those domestic equities that are really being pushed forward by those companies that we touched on earlier, like the Googles and the Amazons.
I just wish they used better colors.
Yeah, the colors are kind of
not great. That's true. But yeah, I think.
All right. So now we're on to the main event. Stuart and I and Jordan were introduced about a couple of years ago now, and Stuart's become a part of our practice, a part of both as us being clients, as well as us really working together just through different clients and through different experiences. Shortly after I met Stuart, I had a mastermind meeting of business owners, and his partner Norm Kallen is in there, and another sharp gentleman in the M&A and sharp legal mind. So having him on our team has been great, and just the amount of information that he has in the space has really kind of helped us grow as a firm. It's also helped our clients in certain scenarios. So that's why we wanted to have him on. He's the co-founder and managing partner of Brown Moskowitz Kallen. He oversees the firm's corporate, commercial, and transactional practices and provides comprehensive business counseling with particular emphasis on the needs of privately owned businesses. Extensive experience in quarterbacking all aspects of finance, debt, acquisition, disposition, merger, and joint venture transactions. So he helps across the board whenever you're transacting on businesses. And the quarterbacking is really when he's working with other professionals like us or tax professionals. He's the one who's kind of steering and guiding the ship through the transaction process. He has a lot to share with us, and today's topic is really working around representing a seller in a transaction. And Stu, why don't you kind of kick us off and talk to us a little bit about the topic at hand and some of the things that you thought would be useful to our listeners here in regards to transacting on a sale.
Sure. Well, first of all,
where do you want to start?
Well, first, I want to start with thanking you for inviting me. I really appreciate it. And I look forward to this conversation. Let's begin with, as a business owner, when do you think you should start the process of selling your business? I get asked that question all the time. And I think the answer to the question, believe it or not, is the day you start your business. You have to start thinking about the exit. And that may seem like a facetious statement, but it's really not. Because at any given point in time, you as the business owner may receive an unsolicited offer to buy your business, and you have to be prepared because you never know when it's going to be the right time. So toward that end, let's begin at the beginning. And the beginning is really, if I'm a seller of a business, how do I know I'm ready to sell? And there's really two components to it. You have to be financially ready, and we'll discuss that in a moment, and you have to be emotionally ready. And both of those are equally important. So when are you financially ready? You're financially ready after you've spoken to guys like yourselves and your accountant to determine, in effect, what you would need in order to sell your business. Right now,
Stuart, that's the funny part too, because a lot of people who come in and they think that they have a value on their business, they don't really know how to value their business. They're using some sort of rule of thumb, maybe a multiple of EBITDA or a multiple of revenue. And at the end of the day, if the longer you wait to go through this process, to your point, start a business with the intent of selling it, but run it like you're going to run it forever. When you get to the table, you don't want to find out that your business is worth a substantially less than what you had anticipated. So the sooner you can start to represent the true value of your business and start to put the targets out in terms of what you need, then you can start building for the business you need, as opposed to the business that's just helping you to fund your lifestyle.
exactly. And oftentimes, you guys probably hear this as well. Oftentimes people come in and they say, my business is worth $100 million. Well, that's nice. I hope every business is worth $100 million. But at the end of the day, it's not necessarily what your business is worth. It's what you need at the end of the day. And what I'm talking about, what you need is after-tax proceeds that you will receive as part of the transaction. That's critical. And it's not just a function of what you're going to get in the future. It's a function of what you walk away from the closing table with. Because the only thing anybody can guarantee you is what you walk away from the closing table with. So toward that end, it's a good segue, Bobby, into how do you prepare for a sale? And the best way to prepare is to put together a really good deal team. And who's on the deal team? I look at it like this. It's a stool, and you have to support the stool with strong legs. So obviously the seller, as the business person, is one of the legs. The attorney, who's an M&A attorney like myself, would be another leg. The accountant, who is more than just a 1040 accountant, somebody who has gone through the process of an M&A sale or an M&A purchase, would be another leg of the stool. And obviously it's not saving the best for last or saying that it's the weakest for last. It's your financial planner or your wealth planner, because at the end of the day, again, you have to know how you're going to live with the money that you receive. So those are the four legs of the stool. And before you go any further, you really have to assemble a very good deal team. And it's not only important to assemble a good deal team, it's important to assemble a deal team that can communicate well with each other. So that's very important from my perspective. So once
where do you find that that clients are usually starting? Where do you see that they usually start the conversation? Ones that really, aren't going through the process that we always envision of, determining if the business is worth what they think it's worth or what somebody's willing to purchase it for. It was given it's the right, it's the right value to allow them to live the life that they want to live.
Right.
They're just coming in and they're just saying, I think I want to sell the business. Where do they usually start?
Well, it usually starts with the accountant to begin with, and it goes from there. But in terms of starting the process, if that's what you're getting at, it really becomes a function of trying to figure out, okay, if the accountant says your business is worth X, then the business owner says, okay, where do I go from there? And a good deal accountant will say, as I just said, put your team together, and then we can have a conversation. And once your team is together, oh, by the way, the other party that has to be part of this usually would be an investment banker. Once your team is together, then you can start discussing, how do I go through the process? So let's spend a couple of minutes talking about a process per se. So an M&A process, first of all, is not a 30-day process. It's not a 60-day process, and it's not a 90-day process. It can last between, these days, anywhere between 4 months and more than a year. And you may say, wow, that's a really long period of time. And yes, it is. And business owners have to realize you have to stay focused on your business. Do not fall in love with the M&A process. A lot of people think it's really interesting and intricate and involved. You have to realize without your business, there is no process. So you have to stay very focused on running your business.
What do you see as one of the biggest hiccups or hangups that that clients have when they're coming into the process that really slows everything down?
That's an excellent question. The primary reason that deals slow down is because they don't have the time to focus. And I just told you, you have to focus on your business. So you need people as a business seller under the tent. What does that mean? People who you trust within your business who can assist you with the process. It's usually your controller or your CFO, someone like that, perhaps your COO. And oftentimes in small businesses, those roles are not clearly defined. So the business owner has to come to terms with who are they going to let know about this
And
process.
how often do you see some of the impediments being really the seller just isn't operationally prepared to take on or present their company in a way that is going to be giving them the highest return or value in the sale?
Well,
Meaning maybe their books aren't in order, their operations aren't in order, their processes aren't in order, maybe it's they're too much of the business, or they have one or two singular clients that make up 80% of their revenue, and they haven't filled that out or had the right contracts in place. When do you find that operations really kind of slows you down? How often do you see that?
all the time. That's consistent. Rarely do you find a client that is spot on, ready to go. And there are really 4 areas that we have to focus on, and that's called due diligence. And we have to focus on the following areas. You have to prepare financial statements appropriately, which is something you had just mentioned. So whether you just have a company that has tax returns because you don't need financial statements, oftentimes as part of the process, you'll work with your accountant to prepare financial statements. You have to consider employees as well. So you have to determine whether or not you need employment agreements, right to work for hire agreements. You have to check your retirement accounts within the company, like a 401k, to make sure it's properly funded. You have to determine whether or not, if you're a union shop, your union agreements are in place, so on and so forth. The third category is intellectual property. Oftentimes people neglect to consider their intellectual property. I often hear people say, well, we don't have intellectual property. Do you have a website? Yes. You have intellectual property. Do you have a name? Yes. You have intellectual property. So intellectual property is an asset just like any other asset, and that should be at least explored to determine whether or not you can protect it to drive value through your business. And then finally, and this is just a summary, obviously, it's important to review your agreements. And Bob, you sort of touched on that as well. If you have customer concentration in your business, so let's say 80% of your business is done by 20% of your customers, you have to make sure that you have appropriate agreements in place with those customers, or with your suppliers, or with your vendors, because a buyer is going to want to review that and understand what it says. And it's okay if you don't have written agreements, but at the very least, you have to be able to articulate for a buyer what the terms of that oral agreement would be. You would be surprised how many times I hear, well, I don't know, we just get on the phone with them. Every once in a while, they place an order and we fulfill it. And that's it. Well, that's great because you know your customer and you know your business. A buyer doesn't know your customer, and a buyer doesn't know your business. So this is all part of the due diligence process, which in my opinion should take place before you go to market. You really have to understand your own business. And the way you understand your own business is to work with professionals, your deal team, to help you. So
You gotta, they always say you gotta spend money to make money. And I think in this situation, people have to understand that there's a cost to transact that goes beyond any ideas of, I don't want to pay a broker to sell my business. Well, if you want to have the right team, you're going to have to pay an accountant, you're going to have to pay an attorney, you're going to have to pay, maybe for an official valuation, using valuation experts. There are going to be ancillary costs, and it's all just part of transacting.
that's exactly right. And you left out one important one, which would be something called the quality of earnings review. So these
Right.
expenses are not insignificant. And you're right. Oftentimes sellers say, well, can't I just find somebody and sell them my business? Well, again, it doesn't matter the dollar amount, it matters the complexity of your business. You can have a very complex deal that's less than $1 million, or a very simple deal that's worth multiples of millions of dollars. And the answer is it really just depends. But
Well, and for the people who don't keep, they don't keep up with some of the things that they need to keep up operationally, whether it be, to your point, keeping track of earnings, making sure that they have the right documentation in place, having that all at the tail end at the sale is going to be much more of not only a lift, it's going to be a heavier lift for the seller and all of the employees that would help them to gather that information, put all that information together. It's going to be much more costly than if you start to do the right things and trail along until you get to that point where you're going to sell. Well, that transaction will be much easier because you're going to be coming up with a lower cost, a lot less, fine pointed pencils to get in there and really, move things around.
and it will add to the value of the business at the end of the day. Because
Right.
the more, as we call them, warts you can get rid of during your internal due diligence process, the better off you're going to be. You want to be able to put your best foot forward, wear the white hat, call it what you will. But you want to be able to show a buyer that you have your house in order. And to the extent that you can't clean something up, you want to be able to recognize it in advance and be able to explain what it is and how you can rectify it. So moving on to a deal process per se, once you've hired your team and once you've done your internal due diligence, your investment banker, intermediary, advisor, whatever you want to call that party, is going to prepare what's known as a confidential information memorandum, commonly called a SIM. And that document is basically a summary of your business. It's going to have certain financial highlights. It's going to explain what your business is. It's going to explain certain risk factors associated with your business. It's going to explain, not by name, but by category, your customers, your suppliers, so on and so forth. And that SIM is sent out by the investment banker to a targeted audience, generally speaking. And because we have a very limited amount of time here, moving forward, assuming that once the investment banker has identified a few parties who may be interested, we often call them suitors, to acquire your business, there will be an auction process in effect. And
So
those
Stu,
parties,
there's been a lot of I guess there's been a lot of excitement and a lot of energy around people hearing that private equity comes in and buys all of these different businesses. Do you want to weigh in on the, I guess maybe it's the statistics, maybe it's the likelihood, you put it in your terms, but, give some color around what a PE deal, how frequent they come and what might be some of the pros and cons of going through that process.
sure. So there's really, I'll call it a few categories of buyers. There are what we call strategic buyers, which would be not private equity backed, perhaps another competitor of yours who goes in to potentially buy your business. There could be a strategic buyer who is private equity backed to go in and buy your business. There could be financial buyers as well, which would be a private equity firm coming directly to you, or what's known as a family office coming directly to you. There are advantages and disadvantages to each one. Usually, and you got to put big quotes around usually, a direct strategic buyer may offer you the best value, meaning the highest enterprise value for your business. Why? Because they're buying your business based upon a strategic, hence a strategic buyer, a strategic reason. They want to acquire your customers, they want to acquire your intellectual property, they want to acquire your employee base, so on and so forth.
So
And
for instance, do you want to give some color of what a for instance would look like on maybe both direct competition or someone who's in a tangential line of business that would benefit from something like that? Or
well, I'm not exactly sure what you're asking, but if you're asking if a strategic buyer is going to come in and buy your customer list, Yes.
No, I'm saying just to give the audience strategic buyer, maybe give a little bit of an example of one of the, of an industry and how that would fold. So I think a strategic buyer, and I would say it would either be a bigger competitor that's coming in that thinks that they can find efficiencies and more profitability in what you do, but it's also maybe somebody who's doing something in a relative field that can then broaden their base in their offerings.
Well, that's exactly right. We did a deal last year. I'll give you an example where we had a catering business located here in New Jersey sell to a much larger catering business that was a national business that was owned by a private equity group. And this group, the buyer, wanted to plant a flag in New Jersey. So they acquired our client. And they acquired the client for 3 reasons: geography, customers, and goodwill, because our client had a good name. And that made perfect sense for the buyer. Now, a private equity group, straight private equity group acquisition in that case, would not have worked because our client was not large enough to be what's known as a platform company for a private equity group. When a private equity group buys a business, generally speaking, it buys it for one of 2 reasons. The business that is being targeted is large enough to be, again, what we call a platform company, meaning it can be the basis by which a private equity group comes in and bolts on or adds on smaller businesses to it, or it could be that bolt-on or additional business to a platform company. The concept of private equity, in a nutshell, is limited partners buy interest in private equity companies. The limited partners want to make a return. So the private equity group is obligated to put that money to work by buying businesses and ultimately flipping that business within a period of time, generally speaking, 4 to 7 years. So oftentimes, sellers who sell to private equity will have an opportunity to what we call roll forward equity into the deal, meaning they'll sell 100% of their business, but they'll take back a percentage of the buyer. So they may sell 80% of the business for cash and 20% of the business for equity in the buyer. And then 3 to 5 years later, when there's a second exit, they get a second bite at the apple. Hopefully it's a larger bite. So that's the way private equity often works. And then there are family offices. Family offices differ from private equity in that family offices don't have limited partners to answer to. It's usually wealthy families who are looking for a cash-on-cash return rather than a flip. So they'll hold the businesses longer, and therefore oftentimes sellers are interested in those deals because if they have the opportunity to continue on with the business, they'll make a nice return by virtue of the cash-on-cash that's generated. So again, we don't have a lot of time, but those are the types of buyers that you'll generally find out there. And it's important for the seller to identify the type of buyer that it is, and that'll be done by your investment banker and your financial planner and your accountant, and to a limited extent, your attorney, and determine from that what the deal structure is going to be. And I just want to spend a couple of minutes, if we could, on the way these deals are structured. So if you're a seller, you generally have, I'm sorry?
No, I think that would be great. Yeah.
Okay. As a seller, you generally have 2 ways to sell your business. You either sell the stock or the equity in your company, or you sell the assets of your company. And they differ in many different ways. It's advantageous, generally speaking, for a seller to sell the stock or the equity of the company. Why? Because you get, generally speaking, capital gains treatment as opposed to ordinary income. And that's a big difference. Obviously, you guys and the accountant can discuss that with the client. That's number 1. Number 2, if you sell the equity in your business, meaning you're selling your entire business, in effect, all the assets and all the liabilities go along with that sale. So the buyer takes on the assets and takes on, theoretically, the headaches. Now, again, we're doing this at a very high level, and there are shades of gray associated with this, but just by way of example. As opposed to an asset sale, where rather than the individual who owns the company selling, it's really the company itself selling its assets. So the company has hard assets it has intangible assets. For example, the name of the company is an intangible asset, and that's generally associated with goodwill. So the company in an asset sale transaction sells its assets to the buyer. The seller who owns the company retains the company itself, and the sale proceeds go into the company, and then the owner of the company takes a distribution of that sale proceeds. And again, I'm sorry.
What are some of the pros and cons of each? Because, you know, as a seller, you have somebody on the other end who's the buyer, who's going to be looking at trying to, you know, to structure the deal that's going to be most favorable for them and vice versa. So if you could just go into like some of the pros and cons that you see, high level of going in either direction for both the buyer and the seller.
Sure. Obviously, the biggest pro to an equity deal, as I just mentioned, for the seller is the capital gains treatment, as opposed to ordinary income. The biggest con for the buyer in an equity deal is the fact that they're buying the stock or the membership interest in the company, and they can't depreciate the assets. So they're stuck with that value in the company per se. Whereas in an asset deal, the seller, the con to the seller, which is the converse, is it now has ordinary income to pay, or ordinary income tax to pay on the sale. But the buyer, the pro to the buyer in that case, is because it's buying assets, it can depreciate or start depreciating the assets. Now, the IRS, and we don't need to get into detail here, but the IRS recognizes that problem. And the IRS, through certain regulations that it's promulgated, has said, no problem, we could deal with this. So there are certain corporate and tax gymnastics that buyers and sellers go through to be able to accommodate the seller to get capital gains treatment and the buyer to get ordinary income tax treatment to be able to depreciate the assets. I don't want to get into any of that detail because it's for another day.
No, but I wanted to make that point because that really comes in through the transaction, which is why hiring the right professionals, especially the right attorney to put the deal together, it matters. Can't just have your own.
It definitely matters, and I appreciate the plug, but it's really more than just the attorney. It really boils down to the team because A, the investment banker helps you find the buyer. B, your accountant makes sure that at the end of the day, you're doing this in the most tax efficient manner possible. C, your attorney, me, protecting your interests so you know you're going to keep what you get. And D, your financial planner makes sure that whatever you do with those proceeds is going to be sufficient for the lifestyle you want to live once you sell your business. So it really is a team approach here. I have to emphasize that. Very quickly, what does the contract of sale look like? So the contract of sale is basically broken down into a number of different components. The first component, whether it's an asset sale or a stock sale, is basically, what am I selling? So you describe what you're actually selling. If you're selling your stock, you describe the stock. If you're selling the assets, there's usually a long laundry list of the assets that are being sold. The next component is, what's the purchase price? So obviously we have to state what the purchase price is. Now the subcategory of that is, what's the method of payment? And by that, I'll give you a quick example that I use all the time. Bobby, you tell Sean that you're going to buy his business for $1 million. And Sean says, wow, that's awesome. I love it. Now I come in and I say, you know what, Sean, I'm going to buy your business for $100 million. And you say, bye, Bob, gotta go, right? By the way, the rest of the story is I'm going to pay you $1 a year for 100 million years. You still like my deal?
No.
So much, right? So it's very important.
He's out.
Right.
Back to Bob.
Back to Bobby.
Back to Bobby. It's very important that the deal team recognizes the method of payment. So my example was crazy, but it illustrates the point. It's important to understand how the purchase price is being paid. And there's a few different ways it can be paid. It can be paid by cash. It can be paid by deferred payment, meaning a promissory note. It can be paid in a contingent manner, which is called an earnout, It can be paid with rollover equity, which is what we were talking about before, which gives you another bite at the apple. So those are the four general categories of the way purchase price is paid. And there are different tax implications to each category. So again, it's important to really analyze this carefully. So what's the next step in the purchase agreement per se? The next step is what's known as reps and warranties. A representation is a factual statement at a given point in time. So for example, on April 11th at 4:50, we were all on this webinar. That's a factual statement. And the warranty portion of that is on a going forward basis, we are effectively guaranteeing that that statement is true. Okay. And this is the longest section and the most difficult section for sellers to get through in a purchase agreement, because it's very similar to a full body exam. You are going to disclose everything about your company, and you're going to have to make factual statements about it. And that's in large part predicated on the due diligence that we do in advance and that the buyer does during the deal. Why is that important? Because the buyer wants to know what it's getting. And if you make an inaccurate statement or you what we call breach the representation, there are consequences, which gets into the next substantive portion of the purchase agreement, which is known as the indemnification provision. The seller will what's called indemnify, defend, and hold the buyer harmless for a number of different things. A breach of a rep or a warranty, a breach of a covenant. A covenant is nothing more than an affirmative obligation or a negative obligation to do something. So what's an example of that? The seller is going to agree not to compete with the business of the buyer, because it was the seller's business, after the closing. If the seller goes out and works across the street for the competitor, it's breached that covenant, and there will be financial consequences as a result of it. So what we try to do as part of the seller's deal team is limit those indemnification obligations by being very careful with what we say in terms of the reps and warranties, and also putting limits on the indemnification per se. And then obviously there is a bunch of miscellaneous provisions that would go into these agreements, but at a very high level, those are the key provisions that you find in these agreements. In addition to that definitive agreement, you're also going to have oftentimes employment agreements, whether for the seller or for the seller's key employees. And by the way, that's a topic that deserves a separate conversation, because in advance of doing a deal, you want to make sure as the seller that you have created a clear understanding with your employees. You do not want to get into a situation as a seller where you have a guy like Jordan sitting there saying, I am a very key employee, and by the way, I don't have a clear employment agreement. And yeah, you want to sell your business? The buyer really wants me to come along? Well, guess what? I've been loyal to you all these years, but now I want a lot more money if I'm going to work for the buyer. That happens frequently. Greed corrupts. So you have to be very careful and make sure that you have solid employment agreements with your employees that have appropriate language in them regarding the sale of the business.
Yeah, I mean, there are a ton of nuances just, from to your point, thinking about selling at the beginning of starting a business, whether or not it then happens really 5, 10, 15 years that you actually start to think about it. Right. Because not everybody here that's listening is just starting a business tomorrow and they're going to start from day one. They've probably been operating for a few years now, thinking about like, well, at some point, maybe I will. Right. But there's a lot of nuances from the moment you start thinking about it to even the moment that after you receive the check. I mean, it goes well and beyond. So the sooner that you start having these conversations and you could start taking away some of the variables and clearing up some of the unknowns, it's a stressful process. It is not for the faint of heart. And there are more times that we've seen where the buyer is just waiting to exhaust the seller so they can make the concessions and just be done with the deal. And to your point, what you said before, from a seller's perspective, don't get married and don't fall in love with the process, because you're going to forget about your business. And then all of a sudden your business will start to wane. And then the concept of even having to turn around and do a 365 back the way you had to do it prior we'll start to bring you to concede to more and more things at the closing table. So getting that preparation is just as much for the sale and for, you know, for having the right items in place and for lowering your costs at the table, but it's also for your own mindset and your own sanity.
That's exactly right. That's exactly right. So I'll leave you with this. I think it's very important at the beginning of the process to work through with your financial planner and your accountant what you actually need/want. Because there will be ways to accommodate your needs and wants, but unless you identify them up front, it's going to be very difficult to pivot during the transaction. So to the extent that you can, work with your professionals, let them help you figure out what you really want, and toward that end, what you really need. And then allow your professionals to help you achieve that by structuring the deal in the right way and making sure at the end of the day, what you get, you're entitled to keep.
Well, imagine you're in the mindset of, I'm going to retire, I'm going to sell this thing, and you want to do it in the next 2 years, and you just go to find out that you're not going to get as much money as you thought you were. How much more valuable would that information have been 10 years prior? So you can start to think about the things that you can do that would increase the value to the value you need it to be. And how valuable is that information early on also? Because a lot of times we see people who own and run and are thinking about selling a business place a lot of value on things that don't bring them value at the closing table. They spend time, energy, effort, and money doing things that they perceive will bring value, but at the end of the day, they were focusing on the wrong things. If they just swiveled their chair and looked over here, it would have made big, huge differences on how many zeros were on that check versus staying in the sandbox that they thought was going to bring them more value. So I appreciate your time, energy toward this. I know we're catching you at the tail end of the day on a Thursday, but guys, anything from the rest of you in terms of questions to Stu or additional comments that you want to make in regards to the process?
I think it was very helpful, honestly. I think the biggest takeaway is just starting early, getting that deal team together as soon as you can, just so you can have all the pieces of the puzzle kind of helping you to get to where you want to be. But it was very insightful, Stuart, so I appreciate your time.
My pleasure.
Yeah, great stuff, Stuart. And I think like Sean said, this stuff gets complicated really quick. And people sometimes think they can just stumble into this and sell a business, move on, and it's no big deal. There's a lot of work that goes into it. And thank you for highlighting some of those, call it the more touchy stuff. Having to go through and do a full colonoscopy on what your business does and where these expenses are and everything else is not a comfortable process, but it's a big part of the process. And I think you mentioning that moment being one where sellers slow down is an important one for any listeners just to think about, which is you're gonna have to do that. You're gonna have to, like when you're selling your house and you do a big inspection and suddenly they're looking at all the corners and where there's water stains, and you want to be like, oh, never mind that. It's a big part of the process, is just having to go through it, be aware, be conscious, and be prepared to explain why that is and why it makes sense and everything else. And if you can't explain that, or you haven't done that due diligence process, probably do it before you go through the sales process.
Exactly.
So it doesn't pop up at the wrong time.
Yeah, exactly. That's a good point. So guys, at the end of the day, we are going to slice this up and we're going to make categories. So this way it's easy for you to find the information. We're going to release the entirety of the video of the webinar to give us 2 days or so, but beginning of next week. We'll send out to the email to all the people who are viewers and who are also invited to watch and join. Until next month, investment committee will meet again. You'll see some more information coming to us, but we appreciate your time. If you have any questions or concerns or want some personal advice, you can always reach out to us. We can get you in touch with Stuart. Stuart's very accessible, easy to talk to, and thank everybody for their time today, and have a great day.
Thank you very
Come on,
much.
three.
Appreciate it.
One,
Thanks,
two,
everyone.
three.
Thanks, Stuart.
Bye-bye now.
Cheers.